Hey friends, in this video I'm going to go through some common investing mistakes that people make when they start investing in the share market, both in terms of ETFs and individual shares. Now, to prepare for this video, I've gone through some crackers that I've made, but also looked at some common ones in investing books that people have called out saying try to avoid these particular mistakes. So by the end of this video, you should have a good general idea of the pitfalls and the areas to avoid when you start investing in the share market. So let's get into it. So the first one is either deciding not to invest or waiting too long to actually start investing. Now, there are some circumstances, and I'll touch on that a bit later, where you should be keeping a bit of cash in a bank account. But if your strategy towards building wealth is to actually just hold on to cash and keep it in a high interest savings account, you actually end up going backwards, and that's because of this concept called inflation, which you may have heard about in recent news. But currently inflation all over the world, especially in Australia, is sitting around 7%. It's quite high. Now, you can put money into a high interest savings account, but you're getting around 4 or 5%. So there's a 2% differential where you're essentially going backwards. It's a bit like having a treadmill going at a speed of 7, but you're walking at a speed of 4 or 5. You end up sort of going backwards. Now, this graph here shows exactly how the Australian dollar has lost purchasing power over time. And that's essentially what happens is if you do keep your money either stored away or even if you put into a high interest savings account, you're going to end up losing value on that money relative to what's going on with inflation. Now, I know what some of you are thinking. Some of you are like, Sanji, what nonsense are you going on about? Yes, inflation's at 7%. Yes, the interest rates are only 4 to 5% in terms of what I can get from bank accounts. But the share market itself is sitting at a loss right now. We're down 9-10% year to date. And it's unlikely in 2023 that's going to get any better. What's this all about investing in the share market? Well, that's where I will then lead you on to the next key mistake that people often make when it comes to investing, which is not taking into account the time frame that you should be considering. So when it comes to investment timeframes in the context of ETFs, if you look at Vanguard's actual documentation, they specifically call out you should be holding on to these ETFs for 7+ years. 7+ years. Now, they have some ETFs where they'll say it's between 3 to 5 years, but I think the majority of the popular ETFs that most people are considering, it's 7+ years. Now, when I put out a poll on my YouTube webpage and I asked people, what do you actually think? What are your plans for your ETF holdings? It seems like most people are on board with the 7+ year idea. There's a few people who are in the shorter time category, and maybe you had your reasonings for that. But I would encourage you, if you are going into the ETF space or investing in general, try to have a long-term point of view. Now, this does prompt a couple of questions. If you're someone who maybe thought you could jump into the share market to try and help accelerate your deposit building for your house, just hang on. Because if the time frame is 7+ years and you're maybe hoping to get your deposit done in 3 to 5 years, I don't think it matches up. I don't think you should be looking at ETFs. And obviously speak to your top flight financial advisors, but I think the data here is kind of indicating you're taking a bit of a risky approach. And there's a couple of risks. One is you could be fluctuating quite a lot in terms of your deposit amount, whereas if you just put that money into the high interest savings account that I just bagged out a couple of minutes ago, you'd be fine. At least it's going backwards against inflation, but it hasn't gone dramatically down. You haven't had a capital loss event. So that's just something to consider. If you are thinking of investing, generally try to do that if you've already, considered what you're going to do with your house deposit, or you're putting aside money for your house deposit separately to investing, or you've maybe committed to the whole idea of renting for the rest of your life, and that's why you're now getting into investing to build your wealth. Now, I was curious to see where this 7 years fits into the context of other long-term things you might be looking to hold on to. Apparently in the US, most people are holding on to their ETFs for around 2 years. I hope there's something wrong in that data because that's a little bit short. We've got the 7+ years in terms of recommendations. In terms of property, so actual real estate and houses, it seems to be between 9 and 10 years, depending on if you're an owner-occupier or if you're an investor. Not having an emergency fund is one of the other mistakes people often make when they start their investing journey. Now, the whole idea of the emergency fund is a bit of cash on the side that you have in the event you have some life event occur, medical expense, car breaks down, some major bill that you didn't see coming, and you need to pay for it immediately. And you don't want to be in a situation where you have to sell your investments just to use that cash to pay for your emergency. So this is where the recommendations, they do vary a bit in terms of how much you should set aside. So depending on which book you read or which blog article you go to, it seems to vary between 3 months of life expenses through to 6 months of income. So I think you can flex this number around depending on your circumstances. So if you're a single person who's maybe living at home and you don't have a lot of financial expenses, you can probably get away with 3 months of expenses. But if you're someone who's maybe got a mortgage, children, a few things going on, then maybe 6 months of income is probably the more safer thing to have. Now, it doesn't necessarily have to be cash. There's no golden rule saying it has to be cash. It just has to be something that's very liquid, meaning it's very easy to get money out of it, and you know the value of it and should be able to cover what you need in terms of expenses or income. So it could be a PS5, it could be a cat, it could be a bike. Some of you have some incredibly expensive bikes out there, I must say. And it could also be something out of the kitchen, so you never know. Now, the next mistake, I'm going to call it not knowing when to sell or not knowing when to exit an investment. And I think this is most relevant for people who are maybe looking to invest in some individual shares in some individual companies. This is where I've been quite blessed to be on both extremes of this situation. So I can speak to this with great confidence. 2 examples in my life: Galaxy Resources, a lithium miner, and AGL. So Galaxy Resources was a great example where I did a little bit of research. I'll be honest, I did a little bit. I looked at, the fact that it's a single commodity miner. I said, well, it's just going to follow the price of lithium. Price of lithium was going down, so I thought I'd buy some shares in it at around $1.10. Then the price of lithium started going up, and I thought, I'm a genius. Look at this. But I didn't know when to leave. So I kind of panicked when the share price wobbled at $2.68, and I was like, I'm out. But then the share price actually went on to around $5, and that was when it got acquired by another company. Now, I'm not saying I necessarily, I should have been greedy and hung around and all of that. I'm saying if I had actually considered some of the fundamentals of the company and I had backed myself to some extent to saying, look, it's really just riding the commodity price, hang on to it until the commodity price starts to really tank, then I probably would have hung on to it all the way to $5. But now I know. AGL is an example of the other extreme, where I hung on to something a bit too long and saw that I had quite a loss when I should have probably cut my losses and gotten out as quickly as possible. So AGL, I went in at $19.60. Do you remember the days when AGL was worth double digits? Well, those were the days. And then I should have gone out at maybe $16 when I thought, wow, this is not turning. But I hung on to it all the way down to $5.40, $5.41 to be specific. So that was not a great decision. But again, I didn't do the research. I thought, here's a great company, steady dividends, great long-term holding. And I just hung on to it all the way down. The next mistake is around not considering taxes when it comes to investing. So there's 2 situations where you should be very clear and have a good understanding across. The first is around dividends and income, and when you earn dividends you need to pay tax on it, and that's independent of whether you're getting paid out in cash or if you're getting shares. In terms of dividend reinvestments, you need to be setting aside money to pay for taxes in both situations. Now, there is this thing called franking credits which helps reduce that burden a little bit, but the key thing is you need to pay tax on any dividend income you earn. The other tax to consider is around when you make a capital gain. So this is where you buy shares for, say, $1,000 and you sell it for $2,000. Well done. That $1,000 you made, you need to now pay a tax on that gain. It does fluctuate a bit depending on if you hung on to that for the full 12 months or over 12 months or less than 12 months. I'll let you speak to your accountant on that, but that's something to consider. And if we actually think about my Galaxy example, because I didn't really know when to leave that investment, I basically set it up to being around a year after. Now, the next couple of mistakes I actually got from the Getting Started Investing book that I think everyone should probably read when they want to get started on their investing journey. It covers pretty much everything from start to finish. Probably a book I wish was around when I was investing. They've got in there 13 mistakes and lessons that they wish they had learned about before they started their journey. So one of the things they called out in the book was being global. So not just investing in Australia. It's often something we do when we start. We think, let's just invest in the Australian share market. That's the market that I understand well. That's not necessarily the best move because Australia only accounts for a very small proportion of the world's share markets. And there's quite a lot that you can get exposure to and quite a lot of gains that you can get from being exposed to the US markets and other markets as well. Now, you don't have to do this by investing directly in other countries. You can do this still while investing in the Australian share market. Then you can use ETFs that have international exposure like VGS, VEQ, VAE. The other things that Alec and Bryce called out was really around understanding your cognitive biases. So this is things like confirmation bias, loss aversion, choice overload, herding. Make sure you're across that, because that can often, and some of my previous mistakes that I've called out, probably because of some of my cognitive biases. Now, the next mistake is around trying to time the market. And you'll see this where people say, time in the market is better than timing the market. And this is where you're trying to wait for it to have a major drop or a major correction. Then you say, then I'll invest in the share market. Now, there's plenty of content out there that'll tell you about the dangers of trying to time the market. Generally, I've never been able to do it. And generally, I don't trust you if you say, hey, when everything is going bad, I'm going to have money set aside to invest in the share market in that exact moment. Because most of the time when everything's going bad, you're just worried about hanging on to your job and hanging on to everything for dear life. You're not thinking of trying to drop 50 grand to the share market. That's really, I'd be suspicious of that. Now, if you are thinking of individual shares, that I can understand. There are some circumstances where maybe you've done an assessment of a company, you've maybe understood what the intrinsic value is, and you're waiting for the share price to actually come down closer to there. Fair enough. But if it's something like an ETF, the idea is you're just meant to be consistently investing into these things regardless of what's going on in the share market. And if anything, buying more when it gets cheaper than necessarily not buying anything at all and waiting for them to get cheaper. All investments have risks. And another mistake often occurs is where people don't understand the risks of their investments. Now, this I'll split out between individual companies that you might be buying shares in and actual ETFs that you're buying shares in. If it comes to individual companies, it's actually pretty straightforward. In your researching process, look at the documentation, look at the annual reports. I'll show you some examples of Commonwealth Bank of Australia and BHP. They both have clearly put out in their reports the risks of the business. And they're saying these are the kind of things that will have a material or to some extent some kind of material impact on the value of the company and in terms of revenue or cost. So be conscious of them. And you'll know that when you're going into that investment. Now, ETFs are slightly different. They basically have all the risks of all the companies inside them, plus specific risks to ETFs. Again, in the documentation, Vanguard, BetaShares, all of these companies will have it and they'll clearly call them out in terms of all the types of risks that you might have exposure to there. Checking your investments too often. Now, I have been many a times guilty of this, and this is where I'll stop and I'm constantly checking ComSec or CMC markets, and I think the more I look at something, the more I want to do something about it. I want to take action. And the reality is a lot of my investments now, they just need me to put money into them. They don't need me to try and sell a bit or buy a bit there. The idea is just buy consistently on a weekly or monthly basis, Sanji. And I'm really speaking to myself on this. So some of the best things that I've done is actually delete the stocks app from my phone to not monitor the daily movements of my shares, and sometimes even deleted the trading apps on my phone, so I'm just buying through the platform. I don't do that as much now. I do use the CMC mobile app to actually do my purchases, but that's just something to be conscious of. Is the more you look at it, the more you'll have a temptation to want to buy or do something or sell something, or just have an investing plan, have a consistent investing plan and stick to that. And the final one I want to call out is not knowing or not optimizing how much to actually invest into the share market at any given period. So there are now a lot of online calculators that you can use, and I'll throw up some of their screenshots right now, some from Perla, some from some things that someone's just made and put up for free, which will tell you based on how much you're setting aside, what the market is doing, how much your brokerage is. They'll basically help you optimize and tell you what is the frequency and how much should you be putting into the share market trying to optimize for brokerage. Now, if you're not paying for brokerage though, because I think all these calculators are basically trying to help you optimize for brokerage, but if you're not paying for brokerage, then the actual idea is you should be investing as frequently as possible. That's what I do, because I use CMC, where I get free brokerage for anything under $1,000 on a transaction, on my first buy transaction, then it's free. So I try to invest every week, because that is the idea, if you can get time in the market for your investments. But if you have to pay for brokerage through whatever platform, then use these online calculators. They'll help you optimize for it and will tell you the optimal frequency and amount to invest into the share market. So I hope you enjoyed that video. If you have some of your favorites, please comment below. I'm keen to hear, because there's quite a lot that I'm sure we've all made in terms of mistakes when it comes to investing. And I'll see you in the next video. Bye for now.